Okay, good afternoon. My name is Ajay Nair, and on behalf of ASK IM, I welcome you all to our continuing knowledge series on ASK products for this quarter, beginning with our flagship, the ASK Indian Entrepreneur Portfolio. Today we have with us Mr. Sumit Jain. He is the Deputy CIO at ASK IM with around 17 years of experience in Indian capital markets. He was actively involved in the conceptualization of the Indian Entrepreneur Portfolio and currently manages the largest strategy AUM in the country of over $2.5 billion USD. He's been instrumental in building the proprietary valuation models at ASK, and Sumit is what we call a true ASKite. Having joined us in October 2005, he's played a pivotal role in the growth journey for the firm. So Sumit, thank you so much for joining us today. And participants, today we scheduled an hour for this webinar, where I would request if Sumit can cover the broader trends in markets for about 10 odd minutes, followed by a deeper understanding on the ASK IP portfolio. Where do we stand now? How we see things going forward? This interaction then will be followed by question and answers, where I would request all of you to type in your questions and queries related to the portfolio. And what we'll do is we'll curate them and we'll try to get them all answered. So Sumit, again, thank you so much for joining in, and all over to you.
Thank you, Ajay. Is my voice audible?
Yes, loud and clear.
Sure. Friends, welcome to the update call on ASK Indian Entrepreneur Portfolio. We are doing this call at a point in time where markets have been really buoyant. If we look at the performance of markets, if one looks at the low point of this year, from there, large cap index would be up, or rather Nifty would be up close to about 15%. Mid cap index is up 30% plus, and so is small cap index, which is up 35% plus. Right? So markets clearly have given pretty decent returns, at least from the low point of this year. Right? So this begets a question whether how should one think about markets at the current point in time? Are they really overvalued? Should one look at markets from a more longer term perspective at the current point in time? Or should one look at it to play the momentum cycle which is happening at the current point? So let me try to attempt as to what's happening in the market at the current juncture. How at ASK we have positioned our portfolio? How have the quarterly earnings performance been? And how do we anticipate overall portfolio trajectory to kind of move forward? So if you think about markets in general, if one thinks about it from a calendar year perspective, while we may think that India has done well, but this doesn't necessarily be the case that India is the best performing market on a 1 year time frame. India actually lags many of the European countries on a 1 year time frame. Germany, Europe, France, Mexico, Japan, actually they stack much better in terms of their local performance versus India. But where India really scores well is more on a longer term time. If you look at performance of Indian market on 3, 5, or even 10-year basis, India's performance actually has been far superior as compared to many of these markets. So India clearly stands out necessarily from a long-term perspective and may not necessarily from a very short-term perspective. And what is driving this? See, what's happening is, if you look at the rate of growth, India clearly should grow at a rate much faster than many large economies. Among the largest one, India clearly outweighs whether it is emerging markets or whether it is developed markets. Right? So that is something which is working into India's favor. In fact, this is something that is, while I may be showing to you just 1 year or 2 year expectation in terms of rate of growth, but structurally we believe that India is on a path of superior growth trajectory versus many other parts of the world. And there are multiple factors which are actually going right for the country. Demographics, where India clearly stands out, is just one. There is a supply chain dislocation benefit that India is kind of witnessing. There is a manufacturing prowess that India is kind of seeing. So all this while India was working on one single engine, which is consumption. Right now we are seeing consumption firing, manufacturing firing, banking firing. That along with very solid balance sheet of our Indian corporates, Indian consumers, Indian banks, right? So multiple things actually are going right for the country at the current point. And which is why we believe that India is more a structural story rather than a 1 year time frame. Can on a shorter term basis India underperform? That's very much a possibility. We do not want to really time that, but it's more about how we look at it India from a secular perspective. Now let me take you through what is it that is driving equity markets in general. See, first and foremost, if you think about inflation, globally in rate of inflation actually is declining. If you look at US, a year back, inflation was at about 8.5%. Right now it's about 3.2. If you look at EU, it was running close to about 8.99%. It briefly crossed 10% as well, EU, UK. Right, they are now close to 5, 6, 7%. So there is a moderation in inflation trajectory. Will we continue to see inflation going down linearly? Not necessarily. It's going to be with volatility. There are supply chain disruptions. Commodity will continue to remain volatile. So while inflation trajectory may be lower, but it is going to come with certain amount of volatility for sure. Along with inflation, what we have seen world over is interest rates have been increased at a rate which actually has been one of the fastest over last many years. And this clearly will have some repercussions. This clearly will have repercussions on not only corporates, but many economies worldwide. So which is why it's important that one focuses more on the structural part. It's like saying that whenever there is a risk, focus on something which is really strong so that he is in a way last man standing. And same thing probably should happen for many of the countries as well. Coming to India, while we've seen inflation at a CPI level being surprising us negatively, but when we look at core CPI, which is excluding foods and beverages and fuel as well, it's about 5%. So that trajectory actually is on a way down. In fact, clearly RBI to our mind is looking past the inflation that we are seeing because of food. If food doesn't surprise us negatively for a length of time, interest rate should not be challenged, but that remains monitorable. Given the fact that commodity prices may have come down, but many of these commodity prices have risen from lows. Oil clearly has risen pretty decently from lows. Many of the agri commodities have risen up from lows. So if food doesn't surprise us negatively, we should be not too much worrying from an interest rate perspective. Along with that, what is also important, while this may be a global aspect, on the domestic macro front, clearly India's situation over last 1 year or so has also altered meaningfully altered for better. If you look at our forex reserves, they peaked at about $641 billion in somewhere around September 21. From there, we saw reserves being down more than $100 billion, reaching about 525 billion. Now we are back to about 600 plus. So that provides us some comfort with respect to our forex reserves. We kind of cover almost 9 to 10 months of forex reserves from an import perspective at the current point in time. Trade balance is supportive, but it's supportive more because while we are seeing drop in exports at the current point in time, imports are also dropping. This drop in exports is function of few things. Global economic slowdown is just one. We are seeing deflationary-led impact on exports. So to that extent, our exports number would look low. Along with that, what's also happening is there is a global inventory destocking phenomenon, which is also impacting our exports. So quite a few of chemical companies, we saw that the impact on their revenue actually has been pretty high because of the same phenomena that we are witnessing. IT exports last year grew about 8%. We won't be surprised if they continue to grow at 5 to 8% for at least in this year, and then rate of growth kind of accelerating. Right? So to that extent, our overall external vulnerability actually has receded pretty sharply. In fact, so much so that if we look at our crude imports as well, our import or rather our Russian crude in the overall crude basket, actually that number has stacked up pretty well decently. And we believe this could be a structural phenomena as well. It's already close to 40% plus at the current point in time. And this trade in INR gives us lot of, I would say, positive effect on the forex front. So to that extent, our currency volatility should also reduce over period. Now, let me take you through what's happening in our assessment while we talked about what's happening on the external macro front. Let's see what's happening on the concurrent indicators, which are there from an economic perspective. First and foremost is GST. GST numbers continue to stack along really well. But it's not only about GST. More important aspect is PMI, which a number above 50 talks about how there is an expansionary phase that we are witnessing. And not only is our manufacturing above 50, which both of them are close to about 55 plus. So to that extent, our manufacturing PMI is doing all right, services PMI is also. And that actually is backed by how credit growth is being witnessed in the country. Credit growth at about close to 15% plus is a pretty healthy number. And we believe that if nominal GDP growth rate continues to be between 10 to 12%, 13 to 15% credit growth is something that should be a doable number over a long period of time. It's not only credit growth at an aggregate level, retail credit growth, which continues to grow at about 20% for a while, should continue at that rate. Given the fact that India also is turning out to be a more consumption-led economy. Our population is young. Our population is aspirational, seeing higher income levels. And that means that as they start to get a lot of awareness in terms of what's happening in many parts of the world, the urge to kind of have better consumption also is leading to retail credit growing at a relatively decent pace. What's spanner in this whole thing is we are looking at a scenario where rainfall actually is lower than what our long period average is. At the current juncture, it's about 5% lower. There is an expectation that this deficit should reduce, but we'll have to see as to how much it kind of really plays out. At risk are largely eastern states and some bit of western or rather southern states as well. So these are two pockets where in particular we are seeing lower than kind of long period average in terms of rainfall. Some part of it should be covered, but this remains a very key monitorable. And this can mean if it remains in the similar manner, probably food inflation will not come down in a hurry. So to that extent, our regulator have to be kind of bearing that impact for a while. Now let me take you through some important aspect as to where India differs as compared to many other parts of the world. And why do we say that the growth rate in India is a lot more structural? See, if you look at India's own demographic profile, young population, not only is young population is young, but as income level increases, we really believe that premium consumption actually will grow at a rate much faster. And if we look at the penetration of many of the products that India has, it's significantly low. While mobile may be 90% plus penetration, there are many products, refrigerators, mixers, AC, water purifiers, where there is huge scope of penetration-led growth to come by for next many years. And this would be driven as we continue to see income level in the economy kind of getting better. And if we look at the next aspect, which is also about what's happening, while we talked about demographic, which will benefit India over a long period of time, there is very important aspect, which is also about how globally supply chains are getting dislocated and how this can be large driver for India in terms of driving the manufacturing supply chain. See, what's happening post-COVID was the focus on China plus one, focus on Europe plus one actually increased. I mean, many of the corporates who have been focusing largely on one part of the world to source a lot of their inputs have realized that it's important to have supply chain which are more diversified. So to that extent, there are multiple countries that will see benefit of this. India is just one. But the whole thought is, if we can have ecosystem in place to tap this opportunity, then we are in for a very long growth for a length of time. And not only is India would have benefit of manufacturing for the world, India has an advantage of very large domestic market. Not many countries would have that. So to that extent, any manufacturing entity which is looking to put up large manufacturing in the country can kind of service local market and international market. Along with that, what India is also focusing on supply side economics. Government is trying to make sure that infrastructure is in place, focusing on roads, focusing on railways, focusing on airports and other in terms of providing that supply side economics. Along with that, government is trying to make sure that policy framework is also in place. What is important always is to have policies which are a lot more stable, and which is why I think PLI, which India has institutionalized, should play a very important role. So very high focus on supply side economics, supportive policy coupled with manpower, where we have decent amount of manpower, whether it is intellectual or labor, that is available at scale and at cost, which is pretty decent. So to that extent, we have supportive forces available, and then an opportunity to really cater to the world and cater to Indian market. And which is why we really believe that the theme of India's manufacturing actually is just starting. In fact, this is something where we believe longer term, there is a lot of opportunity. And when manufacturing starts to do well, we start to see a lot of engines starting to roll up. We see capital goods businesses doing well. We see consumable businesses doing well. We see staffing businesses doing well. Logistic businesses doing well. So, the whole ecosystem actually is now starting to take shape at the current point in time. This slide talks about how or what are the areas where so far PLI has been kind of institutionalized. And this is just the start. We believe this will induce significant capex, and significant amount of revenues from this capex is expected over next many years. Now let me take you through one very important aspect as to how has been the performance of India Incorporate. Because at the end of the day, over longer term, Indian markets should track the corporate earnings growth profile for 10 years virtually. If we look at the cumulative profits of all the listed businesses, that didn't grow significantly. In fact, it was largely in a band. From FY20 to FY23, profit curve actually galloped, and so have market cap curve as well. So, over a long period of time, both these actually are really interlinked. In that context, let me take you through what has happened in the quarter gone by. While overall revenue growth for India Incorporate was not very solid, but we have to look at it from different perspectives. There has been a deflation in the commodities, so that has had some impact on revenue number. There also has been impact on export businesses. To that extent, those businesses revenue growth actually has got jeopardized. So to that extent, if we look at revenue growth for India Incorporate, BSE 500 revenue growth was barely about 5%. If we look at profit growth for BSE 500, that has been 20% plus. That has been a very solid number that has been delivered. So what has been the driver of this profit growth? Multiple. Banks actually did well. Premium consumption did well. Auto businesses did well. Energy businesses did well. Which are the businesses that actually got impacted? Businesses which are rather linked to how globally things are playing out, right? So IT, we have seen impact. Chemicals, we have seen impact. Metals, we have seen impact. Those businesses actually have got impacted in this quarter. Similarly, when we look at domestically, low ticket consumption actually bore a significantly higher brunt of the relatively higher inflation trajectory that we've seen. At the current juncture, while the rate of growth continues to remain low, what we are seeing is deterioration on the rural side has decelerated. So to that extent, on one side, premium consumption is doing all right, while deterioration on rural consumption is slowing down. So net picture may be mixed, but it's only getting better. On the banking front, banking businesses actually have been beneficiary of, in last fiscal year, beneficiary of solid AUM growth. Credit growth continues to be kind of running really well. They have been beneficiary of NIM expansion, and at the same time, very solid control over gross NPA. At the current juncture, what's happening is NIM increase may have stalled. This would start to, rather on the NBFC's front, we should start to see NIM's expansion over next, probably after quarter or two, right? But banking businesses have started to see NIM's moderation. But the other two pieces, which is kind of AUM growth and gross NPA, those remain firmly under control. So of the three important pieces, two remains to be firmly under control, and which is why we believe banking as a space looks attractive at the current point in time. Valuations there are also pretty reasonable. Consumption, premium consumption is a very, very long-term theme, and its jewelry businesses have done well, right? So to that extent, we believe over next many years, as income level increases, that part of the business market should also start to get better. In case of exports, IT businesses should continue to be impacted by global vagaries, and that is not changing in a hurry. So rate of growth there should continue to remain probably for large businesses close to about high single digit or low double digit. But what's happening is pharma businesses, I mean, US pharma cycle has been in a downtrend for last 10 years. At the current juncture, we are starting to see some bit change in the US pharma business cycle. There has been drug shortages in US, and that is leading to relatively lower erosion in US generic pharma space, and consequently profit numbers also in that space have actually got better. Commodities is one area where things will continue to remain volatile. If overall global growth continues to remain mild in slowdown, commodities barring some bits here and there, if supply chain disruption don't increases dramatically, they should remain under check, and which is why we are not too worried of inflation as well in terms of that flowing through on the commodity side. Coming to very important piece, which is how investment businesses or manufacturing businesses are doing. At the current juncture, industrial businesses are benefiting from record high order inflow growth. They are benefiting from solid execution, manufacturing in India. So to that extent, that part of the market actually is doing well. Cement businesses actually should start to see profit improvement after a quarter or so, given the fact that underlying raw material prices have actually softened. Volume growth continues to remain pretty decent. So this year is a pre-election year. We should see pretty decent growth in cement consumption, pretty decent growth in many of these infrastructure related businesses. While this year may be a solid growth, the way India has charted out its path structurally as well, this is something that should do well. Now let me take you through how our portfolio has done versus the Nifty as a whole. Nifty 50 earnings has grown 32%, but that has been driven pretty largely, pretty decently by a few OMCs. They have been, I mean, last year they had pretty sharp impact on their profitability. This year we are seeing very sharp growth in their marketing margins. X of OMCs, Nifty 50 earnings grew 19%. ASK IEP portfolio earnings grew 29%. This is just a quarter phenomena. This doesn't give us too much joy. How earnings are playing out this year and next is more important. If you look at FY24 earnings, FY24 in entirety, we believe our portfolio earnings growth should be more like 25% plus. And we should maintain this kind of earnings growth next year as well. While Nifty 50 should be about 13 to 15% in terms of return. So pretty superior in terms of earnings growth profile is what our businesses are at the current point in time. Now let me take you through how has our positioning changed in terms of our portfolio since the time we last interacted. So this talks about change in our portfolio positioning versus 31st March till 16th of August. In general, our exposure towards banks have increased. We believe that banking is one area which is a very, very long-term thing. A well-run bank should continue to give us superior compounding returns. But at the same time, we have a very solid exposure towards NBFCs as well. A well-run NBFCs who understands their customer really well, who is making right use of technology, should be growing at a rate much faster than banking system as a whole as well. And that, along with a very superior ROE, should continue to deliver superior returns. So while at an aggregate level, we may have bank financials similar to what it is for BSE 500, but our mix is dramatically different. Consumption, premium consumption, we have relatively higher exposure. It continues to remain that way. We now have a relatively higher exposure towards healthcare. We just discussed as to how US generic pharma space, we believe that the price erosion has kind of reduced, and consequently, we have an exposure there. Overall, now we have in the pharma space, domestic beneficiary of continuing domestic pharma cycle, beneficiary of US generic space, and beneficiary of the API. So we have a complete basket on the healthcare space, and we believe that this space should be relatively higher in terms of our exposure versus for the benchmarks. So that's a large, I mean, relatively one change that we have brought about in terms of our portfolio positioning. Pharma relatively higher, finance relatively higher as compared to what we had last time. How does our portfolio stack up on an overall basis? As we just discussed, overall earnings growth of 25% plus this year and next, with a very solid capital efficiency. Because at the end of the day, ROC determines what is the strength that business has created. And ROC not at a point in time, is it really sustainable or not? That's the key. Most of our businesses have shown relatively higher ability to report relatively superior capital efficiency across varied business cycles. Right? So it's all the more important during times like this when markets have had a decent run up. Focus on quality businesses becomes a lot more paramount. So which is why we would not like to change our positioning on the capital efficiency front. And at the end of the day, it's that business strength compounding in earnings that actually creates return over long period of time. Now let me take you through what are the key monitorables in the economy at the current point in time. That's very important, because if we look at inflation, CPI inflation, while core may be down, but food inflation is something that should be key monitorable. El Nino is resulting in poor rainfall. We have election in multiple states, right? And again, general election next year. So to that extent, that remains a very key monitorable. Global environment can have impact on exports in the short period of time. Structurally, the way India is kind of focusing on our manufacturing engine, we think we'll pass this hump, but in the short period, this is having some impact. And clearly, geopolitics or China risk remains. So these are key monitorables, and these are monitorables more so at a point where valuations differential between large and small businesses have reduced dramatically. So it's all the more important that we focus more on businesses which have strength, businesses where there is longevity, businesses where earnings growth will be superior over long period of time versus other part of the market. And which is why I would believe this kind of positioning should do relatively better over next 2 years. And if you look at the performance, while last calendar year was a difficult year for IEP portfolio, this calendar year is turning out to be a lot better. This fiscal year, we are already up about 23% in last 4-5 months. So to that extent, portfolio has bounced decently along with markets. We really believe that earnings growth trajectory of our portfolio remains strong. Portfolio has still not caught up with how earnings growth is really playing out. So can there be scope of continued business performance and then consequently portfolio performance? We really believe so. So this has been on the performance. I'm open to questions.
So thank you again, Sumit, for the detailed overview. I think you covered the drivers for growth, both domestic and global, very well, along with investments, and you also gave a strong overview for the IEP portfolio. But I can see there are still multiple questions that are getting raised right now in the chat box. And I'll still request participants to keep writing your questions in the Q&A chat box, and we'll try and answer them as much as possible. So let me take the first one. I think I'm just clubbing a few questions together. You know, you spoke about the quarterly results that we saw, and you saw margin expansion happening across broader markets. And if I look at IEP as well, I think you gave out very specific data points for the overall portfolio. But if I go deeper and look at the stocks within the portfolio, were the earnings within expected lines? Were they above? Were they lower? If you can just spend a couple of minutes there as well.
See, by and large, most of the businesses have delivered in line or better than estimated earnings. More than 80% of the portfolio actually have delivered earnings which have actually either been in line or better than estimates. There have been very few instances where earnings have surprised us negatively, and that too of an order which is not very significant. So, for example, if you think about Titan Industries, wherein earnings were slightly lower than what we had anticipated, it has been more because of not because of revenue growth, but because of margins turning out to be lower than what we had anticipated. So this is something can happen in a business. Not overly worried in any of those businesses which have kind of reported lower than estimates. In fact, I must say, there are many businesses actually which have reported earnings significantly better than what we had thought. For example, APL Apollo continues to do really well, not only in terms of volumes, but in terms of margins as well. And we anticipate many of these margins lever to continue to work along going forward. Right? So net earnings negative surprises have been significantly lower than either in line or better than estimates. And as I said, less than 20% of the businesses have kind of been lower than estimates.
Understood. Thanks so much for that. I think, again, one common theme coming out, and let me just maybe concise it a bit. Everyone's talking about manufacturing. I think with corporate tax reduction, PLI, China plus one, or maybe some saying as minus China. How do we view the space of manufacturing, and how are we actually playing it out in our portfolio itself?
See, manufacturing clearly is a very big thing. It encompasses multiple aspects which we just discussed, whether it is capital goods, whether it is consumables, whether it is logistics, whether it is staffing, right? And when manufacturing does well, many of those consumables like cables and all also starts to do really well. So there are different ways to really play the entire cycle. Some may play directly through capital goods, some may play through beneficiary of the entire landscape. We have chosen to, at the current juncture, we've chosen to play through indirect route. For example, if there are a lot of factories that get built up, right? There is a lot of buildings that gets built up. APL Apollo actually benefits dramatically. Cable wire business of Havells benefit when there is a manufacturing activity that gets better, right? So I agree with you that this is one space which should do well over next many years, and we will continue to focus significantly higher on this part of the market.
Thanks so much, Sumit, again. I think a lot of questions are coming on Geo Finance here. So one question which is coming is that what is the overall view on Geo, and does it really pose a risk on something that we hold in the portfolio, which is the Bajaj Finance? How do you view that at the current juncture?
See, Bajaj Finance, first let's look at the opportunity. Opportunity is significantly large. Not only is it large, it's getting larger, right? Can there be scope of multiple players in this whole entire landscape? There ought to be. It's not that it will be ruled by very few players. But at the same time, we really need to see how Jio Financial really execute the entire business proposition. They also have multiple opportunities in their arena. They have a very solid retail space, retail business. They also can fund broadband business, right? So to that extent, there can be some overlap, and plus there can be some businesses which are not necessarily overlap. But suffice it to say, opportunity landscape for both businesses are really high. And lending is a business which involves a lot of friction. You give loan, and then it is all the more important to understand whom you are lending to, right? There is a cost to collect this money back. So building this business, understanding the customer, having all that data is a process. There is a learning curve, right? So Jio will also may also undergo that learning curve, and to that extent, we will continue to monitor this space. But I would think that Bajaj Finance has really built a very solid business proposition for themselves at the current point in time.
Perfect. Good insight there with regards to Jio as well. Again, lots of stock-specific questions coming in, so let me just share some immediately. One is coming with regards to Kotak. So multiple questions getting arise on Kotak specifically, saying that if you look at Kotak Mahindra Bank has been a laggard in terms of performance for quite some time. And we do hold other banks in the portfolio which have been doing much better. So what is the view, what is the rationale that we continue to hold Kotak at the current juncture? And what may be the reason why it hasn't formed in the recent past?
See, we all know that term of Mr. Uday Kotak should end shortly. So there is this uncertainty as to who would kind of run the show. Is business on decent wicket? Business is on decent wicket. So once those air on those uncertainties are behind, we should start to see business performance getting reflected into market performance as well. And we should appreciate many a times stock market performance doesn't necessarily move in line with how business performance is in a very short-term time frame. So to that extent, we really need to kind of focus on it from a long-term perspective. And we believe business is on a right wicket. So to that extent, we are kind of holding on to this name. Our exposure to many other lending institutions is higher as compared to what it is in Kotak. We believe many of those institutions should grow at a rate faster than what Kotak should grow at.
All right. Again, maybe a more generic question which has come in with regards to, although you covered on the manufacturing side, again, the question is coming on infrastructure and engineering sector, not given higher exposure, despite the fact that we're talking about a decent growth coming in from this space.
So we have, as we just discussed, we are playing this space largely through many of those quasi beneficiary of the manufacturing arena. Can there be scope to look at engineering businesses? Clearly, there can be scope to look at engineering businesses in the portfolio. Many of those still are relatively smaller in size. We'll continue to evaluate each of those businesses.
Got it. One more question which was coming in was that if you look at the chemical space, I think everyone's been talking about that quite aggressively. However, in the portfolio, lately we've also exited some names within this theme. And despite the huge scope of opportunity that we foresee for the nearby and long-term future, do we see ourselves again rebuilding larger positions in this space? How do you see that play out within the portfolio?
See, fundamentally, if we think about this space, at the current juncture, impact is twin-pronged. Right? One is demand itself is down globally, and second, these businesses are getting impacted because of what is happening on the inventory destocking front. And consequently, those businesses which supply to those part of the world actually have got impacted. And when revenues don't come by, margins is an outcome. Margins take a bigger knock. we really believe that businesses where there is a decent amount of R&D skill set that is required, where your relationship with clients is lot more integrated, those businesses should actually do well over a long period of time as compared to pure commodity businesses. So we need to segregate specialty versus commodity, and we'll continue to focus on the specialty part of the chemical versus the commodity part of the chemical portfolio.
Okay. Again, multiple questions coming on a single name, which is Avenue Supermart. We've seen the business, or maybe the results, not being so conducive, at least for the last few quarters. And if you look at the stock price movement as well, it's hasn't really contributed. Maybe it's gone to the negative side for the entire portfolio in terms of gains. If you can just build an overview in terms of how we foresee that business play out for us going forward.
See, first, let me talk about what has impacted this business, and then we'll take you through why we believe we would like to hold on to this name. See, any retail business is a combination of multiple things. There are some businesses which are like crowd pullers, and then there are some businesses which allows you to have relatively higher margins. In case of DMart or Avenue Supermart, what is happening is businesses which are crowd pullers are doing all right. But at the same time, the non-FMCG, which is discretionary, which is apparels or other merchandise, revenue growth there has actually got impacted. And that could be because of multiple reasons. And which is why, while revenue has not been a bigger surprise, it has been margins which has been on a lower side, and which is why there has been an impact on the stock price. Is this something really sustainable? We don't believe so. Management is at it, and over period, as we start to see the other part also starting to inch up, margins should normalize. Is there an opportunity for Avenue Supermart to grow for next many years? I believe they're still too small in the overall scheme of things. A business with 40 odd thousand crores of revenues with an opportunity size which is significantly higher, solid balance sheet, ability to price their product significantly lower than its competition. I think the opportunity for this company remains.
Thanks, Sumit. One more question, which maybe is coming from a few pockets here and there, is that you mentioned last year was a tough year for you in CY 22. There's an underperformance job built in the portfolio. And for the last 5 months, you've seen a pretty sharp pullback, which has come back in the portfolio for IEP. What changes would you have done, firstly, to really, which led to this improvement in performance? Second, how do you foresee maybe the gap which got built in last year? Do you foresee that gap getting filled in maybe the immediate future? And what steps would we undertake or have you undertaken to get that done?
See, fundamentally, we'll always be business-focused investors. While over last 4 or 5 months, portfolio has bounced back, we haven't made too much of changes. It's our confidence on those businesses, earnings delivery, that has made us held on to those names. Look at how earnings growth trajectory has been. Portfolio as a whole, last year delivered 20% earnings growth. This year, as we discussed, is going to be higher. And last year, portfolio got impacted because there were quite a few businesses which actually saw impact because of commodity prices going down pretty dramatically. And there were inventory losses in those businesses. This year, we are not seeing any of those impact, and consequently, margins are kind of starting to come back. So, we believe if we continue to focus on right businesses, businesses where there is longevity of earnings growth, businesses which have built capability to increase market share across varied business environment, that portfolio should deliver returns over many years. And that is what we have been doing over last 13 years. We have not thought too much about, we have always been bottom up in terms of our investing style, right? And that style is not changing. If businesses continue to perform, returns are an outcome. And that is where we will continue to kind of keep strengthening the portfolio, and more so in current environment where the risk per se is being ignored by many participants. And that's the point where we should not dilute on quality of management, quality of business.
Absolutely, completely agree on that. Again, one more thread on the question side is coming on the size of the portfolio. Although maybe the recent past is a clear testament that size is just a number if you manage the portfolio properly. But on that question is coming that it might be, limiting, or is that limiting your entire scope in terms of how you wish to invest based on the philosophy that you've built in?
See, we are still not too large to really say that size should have a very large bearing on the portfolio performances. This would have been the case when the opportunity to look at mid-sized businesses or large-sized businesses, or rather the opportunity there itself is receding. We are seeing many mid-sized or large-sized businesses themselves are kind of growing or delivering business performance which is of an order much superior. So to that extent, the opportunity is there. We need to identify those businesses to continue to deliver onto the performance. Is size a constraint at the current point in time? Not necessarily so. See, size becomes a constraint if the thought process is to look for one-time returns. Then the churn in the portfolio also increases dramatically. We look for businesses where the characteristic of those businesses is more compounding in nature. Opportunity is secular, right? That itself increases the capacity of the portfolio. And I'll be surprised if or disappointed if for the reason of size we don't deliver onto performance.
Very true. When you started the presentation, you spoke about valuation, and you mentioned you gave out performance with regards to small cap, mid caps, and large caps. So in the current market scenario, which space segment of the market do you think has the most favorable risk reward?
See, while we don't look at businesses from cap perspective, but that's, today we are seeing one side where there is huge amount of money getting into small cap businesses, and valuation differential, as we just discussed some time back, that differential between large cap and small cap valuation has reduced dramatically, and we give a lot of importance to liquidity as well. Right? So at the current point in time, I would really not dilute on any of the parameters of risk or of quality. This will be very paramount to me at the current juncture.
The next question, so multiple questions from Ms. Patlik. One has come with regards to the valuation and growth prospects for Divi's, Havells, and Astral, very specific, which has been mentioned here. Your views on these three?
See, let's take each of these businesses separately. Havells has two businesses. One is a B2B business, which is close to about 30% of their business. And then they have B2C business, which is 70% of their business. At the current juncture, B2B business is doing really well. But B2C is where, because of what's happening on the consumer sentiment side at the current juncture, it's impacted. But is it something that's permanent? Not really so. See, if you look at their market share positioning, even during times like this, they have actually increased onto their market share. Their competitive performance, or rather performance of the competition, actually has been much lower as compared to what Havells has delivered. So it's a perfect example of a business which is inherently very strong, but undergoing temporary headwinds given slowdown in consumer sentiment at the current point in time. I think this is a business that should be looked out for. So we are actually not worried. Havells, in case of Havells, Lloyd's is a work in progress. While this may be loss making at the current point in time, but we really believe that that's a very conscious strategy, and over period they would start to make sure that this turns profitable. Coming to your second one on Astral, optically, while the valuation looks expensive, in fact it's not cheap, but when I look at business delivery, their business delivery continues to remain significantly better than the competition. Even this quarter, they delivered 30% plus volume growth in their pipes business. So we are people who would not like to dilute on business quality for the reason of valuations, but it should not be such that you will not make returns over next many years. It should not be in the price. There has to be certain semblance to that. We really believe this company should grow not only their pipes business, but they are actually getting into adjacencies as well. So if we look at the history of this business, they started as a CPVC company, then went into PVC pipes as well, then went into adhesives, expanded range in pipes, then went into sanitary ware and multiple other products, right? So consistently increasing their opportunity size, and which is why we believe growth rates here can be pretty decent for a length of time. That's more important. And that too with a very, very solid ROC. Divi's continues to remain, I mean, best in class in its area. That space has got impacted because of what's happening globally, but strength of the business is not going up. In fact, stock has risen in last 6 months pretty decent. So we continue to hold on to the name. Having said that, our exposure to each of these businesses is relatively more moderate.
Across all these names, absolutely. Yeah. So just, I mean, you ended with Divi, so just taking the pharma name as of now, you showcased a bit of realignment in the portfolio as well, where you increase it to now double-digit weightage. And you also mentioned that you're trying to cover all lot of segments on the pharma side. So you've also done one recent entrant, and you maybe covered this a bit, talking about reduced pressure of price erosion happening in the US. So you had Dr. Reddy's. If you can also maybe just throw some light on the stock addition that you've done in the very recent past.
No, sorry, can you repeat?
I was talking about the recent stock addition of Dr. Reddy's.
Yeah.
If you can just give your views in terms of the overall addition done and why.
See, I think the levers for growth for this company are multiple. US generic pharma is just one of the levers. Yeah. They aim to be pretty large entity in the domestic pharma space as well, which itself is growing at high single digit, right? So to that extent, US generic pharma space is one opportunity. Domestic pharma space is second opportunity. They want to grow relatively well on rest of the world front as well. So growth rates there should accelerate. That coupled with their ability to utilize the significant R&D that they've done over the last many years. I mean, R&D that they've done for US markets to other geographies as well. So that could mean this business can grow well with improvement in margins. Their capital efficiency actually remains pretty decent. Even over last 10 years when cycle was under stress, their ROCs and cash flows have been pretty decent. So which is why we believe this is a name where we can compound on.
Perfect. And I sincerely believe that it's going to be a good addition to the entire portfolio. So moving ahead, last few questions, looking at the time that we have. The last question, the second last question really comes in with regards to an Asian base. So we do see a competition heating up and, you know, strong players now coming in this space. So how do we see the entire industry and how do we see Asian in that space?
So see, whenever a new player makes an entry in a market, it's always believed that he would be really, really successful, right? Existing players also have strength. they will also fight it out. Right? So to that extent, while there is a new player who is entering, opportunity also is growing, and Asian Paints is not going to remain in just paints business. They have also kind of entered adhesive business or other building product segments, right? So to that extent, if you look at how many industries have evolved in the past, think about sanitary ware and tiles. Tiles players tried entering into sanitary ware players tried entering into tiles. The success was limited. We'll have to see how this industry will play out. Entry barriers are tough. Entry barriers are high. You got to take space within the retail arena, and we'll watch out for how competition shapes up. But at the current juncture, I must say this is one industry where industry participants themselves have grown pretty decently just by focusing on this one area for a length of time. MNC competition actually, or many of those who have tried to enter, have not found very large success. So we'll continuously watch out for how competition evolves in this area, and if need, we will have to take corrective action. But that is one area we, as investor, will be watchful of in any business that we hold. None of the businesses would be without competition, and competition keeps management also in a pretty agile manner.
Well answered. Thanks so much for that, Sumit. Just one last question. Again, maybe a common thread. This question maybe on a lot of people's mind is that markets are an all-time high. What ideally should investors do, right?
See, it's not that markets have reached all-time high for the first time, right? It's a journey. And I think what we should focus on is corporate earnings delivering on to the business performance. Is it backed by cash flow? So to that extent, at the current juncture, the confidence level on the profit growth over long period is really high. Can there be shorter term mismatches given the fact that inflation may turn up in the short period of time? There could be global worries that may crop up, right? That may happen, but India is one area where the structural drivers are in place. Opportunity is very large, and I don't want to comment on how markets will play out in the short period of time, because if markets move up relatively well in the short period of time, can they go down? That's a very much a possibility. But if one looks at it at performance from last peak, which is what we saw in October 21, returns are not very great. Nifty would be up barely about 5-7%. Small cap index should be up about 7-8%. So, from that point, markets are not up pretty crazily. So, but at the same time, we should not lose sight of quality of business. That is where I would be really focused on.
Perfect, Sumit. Thank you so much. I think we're at the end of the time that we slotted for the entire session today. Thank you so much for the detailed insights that you share on the portfolio as always. It's always a pleasure to get these these data points from you. Sincere thanks to all participants for being on this call and showcasing your faith in ASK. In case if you have more questions, you can reach out to your relationship managers, and we'd love to maybe take more questions offline, one-on-one if required. The endeavor is always that we want to stay connected with you and keep sharing these insights on a regular basis from ASK's end. So with regards to today's call, we'll also be sharing a recording link, which a lot of people have requested. This link will be shared to your email addresses. Once again, thank you so much for joining in. This concludes the session for the day. Thanks a lot.
Thanks a lot, everyone. Thank you.